Welcome to the daily update, where I'll go over the action in the market for Tuesday, July 8th, and we'll see how things look for Wednesday, July 9th.
Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below.
All right, yeah, pretty ho-hum day. The market was in a tight range. It's looking now like it's consolidating. We're not really seeing any big declines. Of course, Monday was a down day. We're still looking positive. We're still above, especially the 20-period moving average. And that's the line between positive and negative in the short term. We're working off a bit of our overbought conditions and extreme positive conditions, but we're just not moving right now. Now, the ADX, which is our trend indicator, it's still suggesting that we're in a trend, and that trend is positive, but the market doesn't really have a lot to go on right now. There was trade news and tariff news that came out, but the market really didn't react to it. It's kind of just ho-hum. And there's other things that I'll go through, but it really didn't provide any kind of a catalyst for things to either be bought or sold in Tuesday's session. So right at the open, we had a flat open, and then prices just spent the day chopping above and below the unchanged level and the daily pivot at 62.31. And very little price movement in the afternoon. Maybe the smart money took the day off. Maybe they're already on more of an extended vacation, but there wasn't really any conviction. And we ended up closing slightly below the daily pivot, virtually unchanged, but it was down slightly. So it goes in the books as a down day. We were down 0.07%, below average with volume. Not a surprise there. We're still positive on all time frames for right now. Now, interest rates are going up, and that's causing some concern. And we're getting closer and closer to that 4.5% level with the 10-year yield. We're also seeing a bit of a rebound in the dollar. That could also pressure stocks as well. All right, some notes. President Trump extended the July 9th trade deadline. It's like, okay, yeah, we kind of figured that out already. Didn't really have much of an impact on the markets, and said there'll be no extensions past August 1st for country that have been receiving these letters that he's been sending out. And then Secretary of Commerce, Lutnick, gave a CNBC interview and said that the EU has made significant real offers, but there's nothing done. It's just, we've been hearing these kinds of things before, and it's kind of the boy who cried wolf type of a thing, either positive or negative there. So the market's just kind of stepping away from that, and everything that's said is not driving the market up or down. And this is more normal. Usually the stock market doesn't pay that much attention to what goes on in Washington, D.C. As I said many times, they treat that more as theater. Well, with Trump as president and being a businessman and doing things in a different way than has been done for a long, it was a long time ago when the U.S. really relied on tariffs. They were hanging on every word, every little announcement, and that would drive the market. Now, at least for this point, because that could change, the market's like, well, okay, we've heard all this stuff before, so we're not really going to react to it. But they're also, in that interview, he said that to open up markets in the U.S., though initial reports now suggest that the EU will receive a letter from the Trump administration. It's like, ooh, you're in trouble now, EU. You're going to get a letter. Okay, trade developments did little to sway the broader markets. The broader market actually held up better than the S&P, and I'll show you those charts. Also, another announcement was made that could have really rattled or helped the markets, whatever, however you look at it. But it's like, okay, we're getting kind of immune to these announcements now. Possible 20% tariffs on pharmaceuticals, and he also signed an executive order that eliminates subsidies for green energy like wind and solar. And this is in furtherance of the Big Beautiful Bill Act. And small caps and mid caps actually had a pretty good day. They were up where the rest of the market was down. But again, we need to see more follow through with this. We've seen this before. And small caps and even mid caps, they've been doing better lately, but then they have a few good days or maybe one good day, and then they start to drift back down. But even though the mega caps and growth did underperform, semis, now they're back to where they were. They had a big loss on Monday. They got most of that back on Tuesday. And shorter list now. The Stoch RSI still not on the list, but the Williams percent R is. Not the CCI 14, but the CCI 20 is on the list, and the stochastics. And we're still looking extreme with the slope oscillator, and we continue to be far away from the 20 period moving average. Little bit of a shorter list here. The TTM Squeeze is now on the list. That's a new addition. We're still in the +3 channel with the standard deviations chart, the rate of change because of the big move up out of the April lows. That's still on here. The momentum oscillators are starting to look extreme, but again, even though we haven't seen much movement, especially in Tuesday's session, the momentum oscillators are still improving. The Sean trend meter is still in that initial extreme area. We continue to be far away from the 50 period moving average, and we're still looking extreme with the bullish percent indexes for both the S&P and NASDAQ 100. No change. Now we are going to get the meeting minutes from the last Fed meeting. We'll see if that ends up having any kind of an impact, but it hasn't to this point changed the overall scenario with what is the Fed doing. And that's another thing that we're kind of seeing. When it's supposed to be the market does things and then the Fed reacts to that. Well, ever since the great financial crisis, it's been the other way around. The market's just waiting to see what's the Fed going to say, what are they going to do, and then the market reacts to what the Fed does or says. And we're seeing a general shift back, and that's kind of the way it's supposed to be. All right, the dollar was up, and interest rates were also up. We're at 4.42% with the 10-year yield, where we had been at 4.39% after Monday. Sentiment just ticked down one notch. We're still looking extreme. We're right on that border between positive and extreme positive there. So we haven't really worked a lot of that area off yet. And we are positive with the trend. And because of the slight down day, combining that with Monday's down day, we are negative. And I'm still keeping the momentum at positive for right now. We're not really seeing any significant decline. Even though Monday was a down day, it didn't really do anything to change our charts. Okay, so we did get the NFIB Small Business Optimism Index. It ticked down a little bit. It came in at 98.6. Last time it was at 98.8. So not a big change there. Consumer credit did go up 5.1 billion. Last time it went up 16.9 billion. So here is a chart of the optimism index for small businesses coming down a little bit. It was declining. You can see more of a trend here, and then we've been improving a little bit over the last couple of readings, and then a drop off, but still adding more in debt as far as consumer credit right here. Okay, so this is the weekly chart of the overbought, oversold composite. We're still at 85. That's a pretty high reading. Now, again, as I always say, we could go higher than this, but we really shot up quickly to a high reading. So we'll see, are we going to level out here and turn and go down, or are we going to have some kind of a breakout day to the upside and then drive this up a little bit more? And then a big second quarter should have the bulls smiling. This just goes back to some statistics put out by Carson, where because we did have a good second quarter. It was crazy. I mean, we had the big downward move, and then we recaptured that, and we're able to get back to all-time highs. But looking at other times when similar things happened, the average return is 4.7%, the median is 4.4%, and then you look out further, and 85% success, 85, and then 75, where it's well above the average, going all the way back to 1950. And we're still seeing where Goldman Sachs and other outfits too, They're raising their earnings as well as the price for the S&P. They're still looking optimistic there and still seeing where the US markets, and this is measured mainly by the S&P 500, consider to be expensive. I usually go over this in the intermarket analysis video, but we've seen this now for the last number of years, and then comparing current valuations to the rest of the world. Buybacks, they're starting to pick up again here. That's positive for the market. The blue line, those are the announced buybacks. The green line, that's kind of leveling out, but still typically going up here. Those are the actual buybacks that happen. And then the dollar's deepest downdraft in 2 decades. Okay, this is what I've been talking about with the dollar being really oversold. And we could get, even if we don't change the overall climate of the dollar declining, we could get enough of a bounce. And typically, when the dollar's going up, that can pressure stocks. And then bond flows, these just look at the different kinds of bonds that are available. And we're actually looking here that we've been seeing money coming out of the longer term and actually getting more into the short term. And then over the weekend with the weekly videos, I do a number of ratios because this can give us some insight. What's the market saying? Are they concerned about interest rates going up? Are they concerned about inflation? And so I keep watching these and feel free to tune into those videos as I prepare them each weekend. And then this is actually old news. I reported on this over the weekend. Usually I report on it on Friday. This is the individual investors and bulls versus bears. We've been able to climb back up slightly above the positive line here. Okay, mega cap growth and tech positioning still coming up here to the green, it's not green, the gold diamond here is the latest high frequency measure. And it has been improving, but we're still below this dashed line for as far as positioning. And then what were the returns for different assets and then the drawdowns? I'm not going to go through all of these. Let's see. I'm looking large cap. These are the ones that we focus on. They had a drawdown of 18.9%, but ended up being up 6.2%. That's a big deal. That's a big move there.
Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you.
Okay, so really boring day here. Flat open, above, below the unchanged level and the daily pivot, and then we just drifted down a little bit going into the close. And not really any big change in the initial overnight session. The futures were quiet before Tuesday's session, and then we had an even more quiet cash session. Still holding up okay here. The blue line's slightly above the red line with the intraday chart of growth versus value. And seeing a little bit of a pullback here. We've been going sideways quite a bit lately. We did see a nice little run up. This is when the market started to break out and set a number of new all-time highs in a row. And then the first day of July, a lot of money went into value. And so we saw this really coming down. And for the most part, it's been trying to show some improvement. So growth was down where value was up for the large caps, up less for the mid caps, and also up less for the small caps. So a bit of a hit here, but still positive with our small cap growth to value ratio, mid cap growth to value ratio, and S&P growth to value ratio. This is still holding up for now, still above the majority of the rainbow with the growth to value ratio here. And we are improving. We're getting really close to a golden cross with the discretionary to staples ratio. So that's been helping things. Discretionary's showing some improvement, even though we've been chopping sideways here. We've been above both of these moving averages long enough, so it's starting to bring the 50-period moving average back up. And we're still positive with the short-term trend. Even though the green line's coming down, the red line also went down. Intermediate term rolling over a little bit with the ADX, but still above the moving average, still positive with the green line above the red line. And dropping off as far as volume, we were pretty much right at the average reading that we get for volume there. Still below 20. VIX is still hanging in there and doing fairly well. Not really spiking up, but it's not really moving down right now either. Also below the moving averages with the VIX of the VIX. And we went up with this fear gauge and we ticked up just a little bit, not very much with this other fear gauge. So a little bit of fear coming back into the market. Declined on the daily chart of the equity put call ratio, but we're continuing to go up with the 5-day chart and a little bit of a tick up here with the 10-day chart. A little bit of additional hedging going on after getting, especially back on the 5-day chart. When we go below this red line, that's when we're starting to look extreme, even though we could go lower than where we're at currently. This is still holding up. The risk on to risk off ratio continues to climb. That's positive. And we're continuing to go up with the high beta versus low beta. That's positive for the market. And this ratio continues to go back down. This is value to tech, an inverse look at growth versus value. And ticking back up, still above the range here with the volatility risk premium, and still holding up a little bit. We were flat based on price. We actually ticked up a little bit here based on volume with the advanced decline line, and no longer extreme, coming down with the 10-day advanced decline oscillator. And coming down, but still above zero with the short and intermediate term advanced decline ratio. And seeing a pullback here of the new highs, but really no expansion and new lows. We're still positive, but rolling over a bit with the 5-day chart and still slightly going up with the 10-day moving average chart. Now, here's where we're seeing a mixed picture. The accumulation distribution, it's positive because we're above the advancing moving average, but you can see it's starting to come down. This tries to measure the shorter term movements. This is the boom indicator here, and we're, for the second day now, still below the moving average, and this is starting to decline. So if you're more short term, you see this as negative. If you're a little bit longer term, you still count this as positive. We're still going up with the Chaikin money flow here. We came down with the histogram, but the red line's still going up. But we're actually turning more negative now with the Chaikin oscillator. We got just a little bit above this green area. We came down. We didn't drop below the moving average after Monday, but after Tuesday, we are seeing this decline. So getting some mixed signals there with our smart money indicators. We're positive with the vortex, and really no change with those stocks in the S&P above their 20-period moving averages. A little bit of a decline with those above their 50-period moving average. We went up a little with the 100-period moving average study and the 200-period moving average study. So really no conviction there. This is still improving longer term. The 10-day average of the highs and lows for the S&P, we're now crossing back above the green line. This is picking up strength that happened last week, and so this is continuing to go up. We're still looking okay with all of our advanced decline lines. We're above advancing moving averages with all of the indexes. And after getting extreme, we are now dropping down with the ZWAG NYSE breadth thrust. Now there's a day lag. This is Monday, the 7th, so we don't get as much of a real-time update with this particular chart. I was pointing out, this is not a signal. We have to go from below the blue line up above the red line within 10 trading days here. We didn't have that extreme negative reading. The reason why I'm picking this up is that we're getting an extreme positive reading, and sometimes that meant we went sideways for a while. Sometimes that might mean that there is a reversal. Still looking good here. The broad market measure of the 5-period moving average of the highs lows, that's continuing to go up. And not really much of a change here on the daily chart. And we're still working off of that recent golden cross, and we were just about at the moving average with volume. Coming down a little bit with the 20, pretty much flat with the 50, and flat with the 200-period moving averages on the S&P. No longer extreme positive with the Stoch RSI. We are coming down, but still extreme with the Williams %R. The CCI 14 is not extreme, but the CCI 20, even though it's declining, it's still above 100. And coming down in the short term, intermediate short term, but still just starting to cross below the moving average with the long short term stochastics chart. And dropping a little bit below the midpoint with the force index. It's positive since it's green, but it's a little more negative when we go down below the midpoint. Still looking okay with the short-term trend based on 20 periods. The lines, for the most part, are still going up. And we're still in the +3 channel with the standard deviations chart. We came down, but we're still above zero with the balance of power. Still looking okay here with the 10, 20, and 30 period moving average steady. We're still well above all three lines. Still positive with the go, no go, darker blue bars. Still just a little bit below the highest high value and above the midpoint here. And looking overextended, when we get above this 40 level, that's a dashed line. That just means that this has gone on for some time, and that gives us a little bit of a warning. Now, there's nothing to say. This could continue to go on. It'll just go further above the dashed line. And we're still positive with the proper order. TTM Squeeze coming right up to the black line here. And this is when we start to consider it to be extreme positive, but it has been improving. And coming down, but still above this red line with the rate of change 50, so it's still extreme, and still just a little bit above zero with the ease of movement. Coming down, but still above zero with the S&P McClellan oscillator, so we're still going up, but you can see we're slowing down a little bit here based on price. Looking at the summation index, rolling over just a little bit more based on volume, but they're both positive for right now. And a little bit of a tick up here, and it's still above zero with the NYSE McClellan oscillator. So we're still going up with the summation index based on price and volume for the NYSE, and still getting a fairly high reading here with the Arun. The oscillator's above zero, showing that there's more buyers than sellers. But we're negative with the Swindler Trading Oscillator. We were negative after Monday. We continue to be negative after Tuesday. We're declining based on price and volume. Still looking extreme above the moving average with the PMO. Still looking good here, but slowing down based on price and volume when we break them out. Declining a little bit, but still above 50 with the PMOs that are rising. Flat to slightly higher, but still above 50 with the buy signals, and pretty much flat, but giving us a high reading with the PMOs above zero. Still neutral with the Elder's Impulse system for the S&P. Still positive with the parabolic SAR. Still positive with the short-term slope oscillator above the green line. We're also rolling over a little bit with the MACD, but still above the moving average. So the short intermediate term oscillators are positive, and now our longer term. The TRIX is actually crossing above the moving average, but we're already above this green line, and we're trying to cross above the moving average here with the KST, but it doesn't have very far to go before it's giving an extreme positive reading. Now, you could start to point out some negative divergences here. As we were going up, a lot of these momentum oscillators were actually going down. Positive with the Copic curve momentum oscillator decline, but still in this kind of darker green area with the Sean trend meter. Declining, but still above 50 with the money flow. Declining, but still above 50 with the ultimate oscillator. Still above the moving average with on-balance volume. No longer extreme with the RSI 14, that's intermediate term, and the RSI 9, which is short term. Still looking good here with the intermediate term trend. We're dealing with the triple exponential moving average here, so both lines continue to go up. And we're above all the plotted moving averages that we see here. That's why we're positive. And this has been encouraging, that even when we were going sideways, all of this was still above the 20-period moving average. But we're still far away from that 20-period moving average and the 50-period moving average. Still going up. This is more constructive and actually positive. We were down on Monday. The bullish percent index went up. We were just nowhere on Tuesday, and we're still going up. So there is some internal buying going on in the S&P. And we're still going up with the NYSE bullish percent index and the NASDAQ 100 bullish percent index. And here's the Pring bottom fisher, which I don't really understand. This is supposed to trigger something after we've seen a pretty big decline. Well, we've been going up, and now we're getting a signal here. I never use this all by itself. It's just part of the overall picture that we use. But this is now generating a buy signal. And still looking okay here with our weekly chart of the S&P. Not much movement thus far. And we're kind of going sideways now with a lot of doji candles with the Heikin Ashi. We're positive since we're black with the Kegi chart, but we continue to point down. We're still positive with the Renko chart, and we're positive with the three-line break chart. Long term, still holding up fairly well with the 150 and 200 period moving average steady. Still having small caps negative in the long term, but everything else is still positive. Bonds are negative across the board on all time frames. Commodities are positive on all time frames. The dollar is still negative on all time frames. And we saw energy, which bounced in Monday's session. It's like OPEC Plus came out and said, we're going to produce more oil. And oil went up. Well, it kept going up. So is this more defensive, or is this just a bounce that energy is seeing after getting rather oversold? Materials had a good day, and we were up with tech, but then healthcare saw a little bit of a bounce as well. But communication ended up being down. And let's see, staples were actually down a little bit. That helped some of our ratios a little bit. Discretionary was also down. Only one trigger here. That's it. Strange. We didn't move. And the NASDAQ crossed down below 20,400. And some green, a lot of red, a lot of indecisiveness here when you look at the market carpet. And coming back down now, is this something to be concerned about? We came right up to this R1 pivot point that acted as overhead resistance, and now we've been starting to come back down with the Dow. We're still neutral though with the Elder's Impulse system, and coming back down a little bit here with the NASDAQ, continuing to be neutral with the NASDAQ Elder's Impulse system, and coming back down a bit. Now the NASDAQ 100 was actually up 0.07%, so it had an up day there, but still neutral with the Qs looking at the Elder's Impulse system. We're rolling over a little bit here with the momentum. We haven't quite rolled over negative yet, but we are not really showing any strength right now with the momentum of the NASDAQ 100. And this is that long-term trend line. We're right about there, and this seems to be where we're stalling out. So we're wondering if that's causing some overhead resistance. And here are the small caps, up 0.78%, getting back up to their 200-day moving average with the S&P 600, and still above the 200-day moving average with the Russell 2000 small caps. Still neutral, though, with the Elder's Impulse system. And up, excuse me, still up 0.4% with the mid caps, hanging on to this R1 pivot level for right now. Neutral with the Elder's Impulse system, and still positive with the Wilshire 5000, even though it was a little changed as well. Sorry, having to clear my voice, to clear my throat again there. Still looking positive with the other broad market measure, the total U.S. stock ETF. Financial sector was down, but still holding up with the uptrend. And we're coming back down again here with the financial to S&P ratio. We want to watch this 200-day moving average to see if that will hold as support if we get down to that point. The FANG index was down, but still looking pretty solid. So Apple was up 0.03%. We had Amazon down 1.84%, just starting to generate a golden cross. Microsoft was down 0.22%, also still in an uptrend. Meta was up 0.32% and in a recent uptrend. And Google was down 1.37%, just a little bit above its 200-day moving average. NVIDIA, recent golden cross, was up over 1%. The semiconductors did okay. And Tesla bounced a little bit after it's just been getting hammered lately. Netflix, also down over 1%, still above its 50-day moving average. And here's the semiconductors. Recent golden cross, looking pretty good, up over 1%. The SMH semiconductor ETF, also up 1.33%. Recent golden cross there. Coming out further above the rainbow with the SMH ETF. And going back up, it's been really jumbled a little bit lately. This is the semis to tech ratio, but overall we have been improving here. And then we look at the staples to tech ratio, and it's not that tech had a pretty good day, but staples got hit pretty hard. So this ratio is still going down, which is more positive. And we're seeing a recent death cross here with this ratio. And we're declining, but not really breaking to the downside here with the staples to S&P ratio. And that's more positive. And just checking into some different ratios here, we're still going sideways for the most part with the weighted discretionary to staples ratio. But when you look at the equal weight, we're actually starting to break out and improving. This is the one that I showed earlier on that has the moving averages. We're seeing tech outperforming utilities. Not much of a change here with biotech to healthcare, but seeing a bit of a bounce up when we compare hotels to utilities. And just kind of leveling off here in the short term correlation between US and world stocks, just drifting a little bit lower with the longer term correlation. Oil was up here. We're getting up into the high 60s again. We did bounce with the dollar, but we've got a lot of damage to repair if we're going to get back and have an uptrend. And we're at 1.66% with the trueflation reading. So that really didn't change all that much. And you can see how interest rates for the 10-year, they're starting to come back up. This red line is the 4.5% level. We want to keep an eye on that. And we continue to go down for the most part with the 10-year based on price. And we're back to being normal again with the 10-year to 3-month yield curve. This is just a little bit uninverted, then it was even, then it was a little bit inverted. We're just watching this to see if it generates some kind of a recessionary signal that we need to watch looking out into the future. The 10 to the 2-year is still looking fine, and that's what most people watch. I also watch this one. And a little bit of an improvement here above the moving average with the Qs to S&P growth to value ratio. It's still discretionary is going down and under a declining moving average when compared to the S&P. Still above the moving average when we compare large cap growth to value. So we're right on the moving average with the large caps, ticking down, but still above the moving average with the mid caps and below the moving average with the small caps. And still seeing this generally going up with the S&P outperforming the utilities, which is positive.
With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial.
So then what's the outlook? We're still positive. We're still trending. We just didn't go anywhere in Tuesday's session. We're going to get every week, we get the MBA mortgage applications index, wholesale inventories, and then probably the biggest thing, if the market even pays attention to it, but it'll probably be a lot of, we don't know, we need more data, we're going to wait and see. But you never know. Something could be in the meeting minutes that actually cause some kind of a catalyst for the market. Anything geopolitical that's going on, Russia, Ukraine, Israel, Iran, those things are still happening. They're just not front page news right now. And then we will get initial jobless claims. This will probably be the biggest report of the week because it's a pretty light week economically. And so then there's a 10-year note auction. This is kind of a big deal. There was a 3-year note auction in Tuesday's session, but the market isn't all that focused on that. But the 10-year, that's the real benchmark. So that might have an impact. And then the meeting minutes will be coming out. Seasonality, we are positive. We're through that 4th, the July 4th. We see a little bit of weakness going into the 4th and then some positive seasonality after that. Going back to 2002, we're positive with all 3 indexes. We'll see if the market cares about that. And this is also showing some positive seasonality going up until about the middle part of July. This is that same chart without all the extra writing on here, also showing some positive seasonality. Doesn't mean it's what's going to happen. This just shows what historically has happened. We're still in the first half of July, which is a really good performing half of the month, going back to 1950. This is also some positive seasonality for the NASDAQ, which could also end up helping out the S&P. So we're still negative for right now. We're improving with the discretionary to staples ratio. It's improving, and we might get close to a golden cross soon, but we're not there yet. The swing trading oscillator is negative, and the longer term special K chart continues to be negative. And we're getting a mixed picture with our 3 smart money indicators. Accumulation distribution, positive if you just look at the indicator and the moving average, where we're negative if you look at the boom indicator. Chicken money flow, that's positive, but the chicken oscillator is now negative. And our longer term growth to value ratio is still hanging in there. And our McClellan oscillators and summation indexes for the NYSE and S&P, those are still positive. Parabolic SAR is positive. The bullish percent indexes, isn't it? This is encouraging, though. This means there's some buying going on that isn't really coming through to the index price itself. We're seeing some more internal strength happening there. And the oscillators are now, for the most part, positive, but they're already looking rather extreme. Ease of movement, money flow, ultimate oscillator, and vortex all still continue to be positive. The financial sector, and we're just hanging on to barely being positive with the momentum for the NASDAQ 100. And we do have a praying bottom Fisher buy signal, but we're not really at a bottom right now. But it's producing a signal, so we just want to be aware of that. Here are the pivot points for Wednesday's session. So no change to the overall conclusion. Positive on all time frames, recent golden cross long term, and we are still trending. Thank you. I hope you have a very good day, and I will talk to you in the next video.